So let's dive right into it. Why is understanding drawdowns so critical in trading?
Because they're inevitable. Every system, no matter how good, will experience them. Knowing the size and frequency of drawdowns helps traders prepare mentally and financially.
Right? And simulations help a lot here. Tharp suggests simulating, say, 200 trades to find the peak-to-trough drawdown.
Exactly. And running 10,000 simulations can give you a statistical profile of what kind of drawdowns to expect. It's like stress testing your system before real money's on the line.
And losing streaks, people often panic when they hit a bad run, but it's part of the game.
For sure. One story really stuck with me. A trader had a system with a 70% win rate but still hit 11 losses in a row during testing. Then, in real trading, he hit 8. He thought the system was broken.
But it wasn't. That streak was still within the system's known limits. That's why knowing those limits up front is so important.
It saves you from emotional decisions. Otherwise, you're just reacting to noise. Trading is already hard. Don't make it harder by being unprepared.
Speaking of being prepared, position sizing plays a massive role in managing drawdowns. I mean, it can completely change your equity curve.
No doubt. Even simple models show this. Risking 2.5% of equity per trade versus just one contract per 100,000, the return exploded, but so did the drawdown.
7.8% drawdown to be exact. That's brutal. Most traders can't stomach that.
And that's the point. Higher return potential sounds great, but it comes at a psychological and financial cost.
It's like choosing between a roller coaster and a steady escalator. One's thrilling but terrifying, the other's boring but safe.
Great analogy. And then there's scaling in, adding to winning positions. More complex, but powerful when used correctly.
Yeah, especially in trend-following systems. If the trend's in your favor and you're moving up your stop, scaling in can be a game changer.
But also risky. In Tharp's example, final position sizes reached 350% of the original. That's huge exposure.
True, and the system was capped at 50% portfolio heat, which is kind of insane.
Right? That's potential ruin territory if you don't manage it precisely. Scaling in is not for the faint of heart.
But look at the outcome. A final equity jumped from 78 million to 640 million. That's eightfold.
Unreal numbers. But again, it's about trade-offs. Big returns, big risks, no free lunch.
That's the key takeaway. No position sizing model is perfect. Each has pros and cons.
Which is why traders need to pick one that fits their personality and goals, not just copy what worked for someone else.
Exactly. You might be fine with a 20% drawdown. Someone else might freak at 10%.
And that freak-out moment, that's when traders abandon perfectly good systems.
All because they didn't understand drawdowns or use proper position sizing. It's like building a house on sand.
So before you obsess over entry signals or new indicators, ask yourself, what's my risk? What's my max pain?
And most importantly, can I sleep at night with this strategy?
That's the real test, because if you can't sleep, you can't trade well.
So here's the closing thought. Are you managing your system, or is your system managing you?
And is your equity curve a reflection of a plan, or a random walk of panic and impulse?
Think about it. That's all for today.